All right, Jedi Options, Wednesday, December 15th. Let's rock and roll. My title for today is Protective Calls. The tagline is "Give me my money back, punk." I think a lot of us who own stocks have suffered a little bit of loss in light of the recent market sell-off. I'm going to teach you a technique that helps you to maybe recoup a little bit of that. I think choices are important and making informed decisions are important. So for those of you who own stocks and your sole technique for minimizing the losses just get stopped out every time, this is going to give you an alternative. Okay. So let's say you bought 100 shares of stock, and it broke support. Bought the stock, it broke support. What are your choices, right? Normally, choice A, you would just exit and take the loss. And the advantage is you can't lose any more money, okay? The pain is stopped. The disadvantage is you can't make money back. You got no shot at redemption. So maybe you get whipped out, and then 3 weeks later, it's back up, and you're like, oh man, I shouldn't have sold it, right? How many of us have had that happen? Millions of times. Another choice, which I'm going to explore today, is to sell an in-the-money covered call to potentially recoup the loss over time. You're not going to recoup the loss immediately. So sell an in-the-money covered call to recoup the loss over time. What you'll see here is the in-the-money call provides some protection and a shot at redemption. You got a chance to make your money back. The risk, because there's always a trade-off, is the stock continues to drop, right? Stock continues to drop and you lose more, okay? The other drawback is you tie up the capital. So you're kind of marrying the stock, tie up the capital. You're marrying the stock for a month, maybe 2 months to try to make the money back. In the event you got stopped out, of course, you could take your money and go try to make it back somewhere else. So I'm assuming that this would be a stock you still like, you still think it's got a shot at recovering, but you'd like to reduce your break even and give yourself a chance to make the money back, right? Okay, so let me give you a key formula that you need to know when you're doing this, and then I'll help you to know what strike price you would sell, and we'll do an example actually on Ford, which we've already talked about today. So the key formula here is if the call strike price that you sell is greater than or equal, oh, actually, no, I got to add something, plus the premium of the call that you sell. So the strike price, add the premium to that. If that is greater than or equal to the original purchase price of the stock, then you got a shot at making your money back, okay? So I'm going to copy paste here because I have this written out to save myself some time, but then you can recoup loss if the stock is above the strike price at expiration. Okay, one more tidbit, and then we'll look at an example. So what covered call do you sell? When it comes to call strike selection, actually, let me just say call option selection here. I would try to sell about a 1 month option. If you sell a 3 month covered call, it takes you 3 months to make your money back, okay? Unless the stock goes up a ton in the interim, right? So I'd prefer to make the money back over a month versus 2 months if possible. So I usually look at the front month options, and then if there's not enough premium in those, then you have to go out to 2 months or 3 months. But starting out, I would look at 1 month, and I would look at one strike in the money first. If there's enough premium in that, you might be able to go 2 strikes in the money to get more protection. But if you sell too far in the money, there isn't enough time value to recoup your loss. And so selling like around at the money, slightly in the money, those have a lot of time value, which gives you the best possibility of making back your loss. Okay. The final thing I'll say before the example here is, I just lost a train of thought. What was the final thing? It'll come back to me. Okay, let's use Ford. Let's suppose I bought Ford stock on the breakout and my purchase price was $20.60. I remember what I escaped me a second ago. Here's another key point. I just lost it. I'm not very Jedi Master today. I don't know what it's. Oh, no, I remember. Okay. So this doesn't work if the stock has fallen too far. You cannot buy a stock, have it go down 50%, and then sell a covered call and make your money back. Okay. It's going to take you a long time to make the money back. The ideal situation for this is you bought a stock and it dropped 2%, 3%, 5% maybe. Okay. So it's not going to work if you wait too long. All right. So presumably you buy a stock and then the first support level it breaks, hopefully it's somewhat close to your entry. That's where you would execute this strategy. You can't be like Mark and you bought SoFi at 24 and it's at 14 and you're like, that's okay. I'll sell a covered call, make my money back. No, you're down $10, man. It's going to take you a while to make that back. Okay. The reason why I like Ford as the example for today is because it's not down that much from that breakout, right? And this is a situation where you know the breakout failed, so you're not as bullish, but maybe you don't want to get stopped out because in a month Ford could go right back up. And so I want to do something in the meantime to stay in the position, but to give me a shot to make my money back and also have a little bit of protection if Ford remains messy for a spell, right? So I bought Ford at 2060, and it's currently, I think when I looked at it earlier today, it's 1970. So I bought Ford right around somewhere here on the breakout, and now it's down at 1970. So I'm down about 90 cents. Okay, so currently at 1970. So I have an unrealized loss of 90 cents. So choice A is I stop out, right? Stop out, eat the 90-cent loss. Presumably you have 100 shares, as I said, so that's $90. Advantage is you can't lose anymore. Disadvantage is if Ford recovers, you don't make your money back. So choice B, using today's tactic, is to sell hopefully a 1 month in the money covered call to recoup the loss and have some protection. So the key is I have to get enough premium in that in the money call to recoup the loss. And this is the way that I would kind of visualize this. Okay. I would look at the time value primarily of the option that I sell. Okay, so let's set the stage. So I bought the stock at, let's say, $20.60. And it's down here at 1970. So I'm sitting on a 70-cent loss. 70-cent loss, okay? And I want to sell, if I sell a 20-strike covered call or a 21-strike covered call, I don't get a lot of protection. So this is a protective call. So to get more juice, to get more premium, we're going to sell in the money. Okay, so I'm going to sell, this 19-strike call option. Okay, so let me take a look at what's available. Again, I'm not going to go out too far in time if I can avoid it. So I'm going to look at the Jan 21 37-day out. 19 is the first strike in the money. Okay, first strike in the money. If I sell the 19 call and I bring in, let's just say $1.65 to make the math easy, 19, that's the strike price, plus $1.65 is $20.65. Is that higher than my purchase price? Yes, I bought the stock at 2060. What that tells me is there's sufficient time premium in that option to recoup my loss as long as Ford is above $19 and the call's in the money at expiration. Now, I might say, oh, well, if that's the case, can I sell further in the money and get even more protection? Well, if you sold the 18 call and you got $2.30, 18 plus $2.30 is $20.30. Well, I bought the stock at 2060, so I wouldn't fully recoup my loss. Well, what if I went to February and I sold the February 18 call? Okay, well, you get $2.75. 18 plus 275 is $20.75. That stands the potential to recoup your loss, and you're protected down to $18. So in this sense, or in this situation, I could sell a Jan 19 call for Ford, be protected down to 19, and as long as we're above 19, I make my money back by Jan expiration. Or I could sell a Feb 18 call, and there's enough time value in there such that if we're above 18 at Feb expiration, I make my money back. I just got to wait 2 months, right? But I'm protected down to 18. So conceptually, we'll go with the 19 strike for January. And that was worth, I said $1.65, I believe. This box is going to represent the premium. Okay. This is the $1.65. This call stocks at 1970. It's a 19 strike call. So 70 cents of the $1.65 is intrinsic value. And what is that? 95 cents. 95 cents is extrinsic value. Okay. And so you'll notice that my 70-cent loss is less than the 95 cents of time value. So if I sell this covered call, there's enough time premium to recoup my current unrealized loss in the stock. So stock goes sideways, stock goes back up, maybe the stock goes down a little bit, but it stays above 19. In either or all three of those cases, come expiration, I'm capturing the $1.65. I'm obligated to sell the stock at 19, but effectively my sell price is $20.65 because I got paid $1.65 to obligate myself to sell the stock at 19. So $20.65 is your effective out. And when you bought the stock, you bought it at $20.60. That's where you got in. So you recouped your loss. And actually you made a couple of bucks, right? Now, the math is a little bit convoluted. Doing a lot of examples really helps, okay? So you can watch this video. You can replay it a couple of times. The key formula, again, I put in the notes here. That is what you want to use to kind of analyze whether the call that you're selling works. But here's the bottom line. You have a choice now, right? You have a choice. I like choices. I like when a stock goes against me to not just have one thing that I always do, but say, hey, maybe in this situation, marrying the stock, selling an in-the-money covered call, making some money back over time. I love the technique. And in markets like this, it really comes in handy.